Good stuff. The question is that the motion be agreed to.
Mr Speaker.
Stuart Nash.
Thank you very much, Mr Speaker. Well, the Minister is right. It is a large tax bill. It is a remedial matters bill. Therefore, there are a number of rather matters, yes, remedial matters in it. It's fixing up a lot of legislation. But, you know, the thing about this tax bill, Mr Speaker, and there have been a number through the House this year, is it's just not dealing with the really substantive issues facing our tax system. I mean, it's great that the aircraft overhaul reserves are being dealt with, and I'm sure those in the airline industry will be really happy about this, because I've no doubt it is something that they have petitioned the government for a long time. But, Mr Speaker, we have a number of very serious issues in our tax system at the moment that have hit not only national headlines but international media and have impacted upon our global reputation. Things like the ability to avoid paying tax in this country, things like inequity in our whole tax system, things like income that can be earned without any tax being paid on it. These are the really big issues, or just a couple of the really big issues that are impacting upon the fairness, coherence and ambitious nature of our tax system, quote unquote, from the Minister over there. Mr Speaker, if the Minister really meant what he said when he talked about a fair tax system, then it would not be this sort of bill that we would be conducting a first reading in. It would truly be an ambitious bill that really worked to deal with the inequities in the tax system that really benefit those who can afford your fancy tax lawyers to engage in a whole lot of aggressive tax planning, while those in the middle and the bottom, certainly middle New Zealand, pay their fair share and feel as if they're getting reamed day after day. Mr Speaker, one thing I would like to talk about a little more than most, and I must say to start with, and I should have said this at the beginning, we will support this bill because Labor supports every single tax bill to the Select Committee so we can hear the experts say, we hear the experts' opinions on this so we can get submitters in and we get a very robust debate. And I must admit, in Select Committee, we find that all parties work together to ensure that any tax legislation that comes before the House is very robust. But, Mr Speaker, let me talk about look-through companies. The Minister very briefly alluded to this, but this is quite a complex area, but it is something I think it's worth expanding on. Now, generally, the company tax regime treats companies and shareholders as separate taxable entities. Companies are taxed at the company rate, which is 28%, and dividends are taxed at the shareholder rate of, say, 33%. It's part of the imputed dividend system. But what this means is if a company is taxed at 28%, it hands out its dividend. If the person receiving the dividend is on the top tax rate, then they've got to pay an extra 5% to bring it up to their marginal tax rate. It's fair because it's all about taxing income at the marginal rate. Well, you'd think that's what the tax system should be based around. But only some income is taxed at a taxpayer's marginal rate, some income is tax-free, for example, capital gains. But one consequence of company law or tax law is that capital gains are tax-free to a company, but then taxed when paid out as a dividend. But the company can distribute capital gains tax-free if that company is liquidated. And company losses are not available to offset against income of shareholders. So if I invest in a company, that company makes a whole lot of loss, but I also get a wage and salary, then I can't write that company loss against my personal income. If you want individual tax treatment, then taxpayers can use a partnership or joint venture, but it's difficult to use in a number of situations. So many investors want the advantage of a company which is limited liability and see therefore legal protection, but the advantages of non-corporate tax treatment, i.e. capital gains tax-free, without needing to liquidate the company and access the losses. So what happened is in 1990, this is quite important because this is a vehicle that the vast majority of people who are accessing capital gains for free, and this is Mr Bennett, as the chair of the Select Committee, you are well aware that a decent chunk of this bill is about look-through companies. And I think if I just rambled on like the Minister did about this, then the people listening to it would have no idea what we're talking about. I think it is only fair that we let people understand the sort of issues we are dealing with. So, Mr Speaker, What happened in the 1990s, the government introduced something called a loss attributing qualifying company, or a qualifying company. And what this did is it taxed at the company tax rate. Capital gains tax were distributable tax-free, and in some cases shareholders could write off the loss attributing qualifying company losses against their own personal income. It was used a lot in the forest industry. For example, where a forest made losses for the first sort of 24 years and only made a gain when it was harvested. So what happened is if an investor invested in the forest industry, he or she could write all those losses off for 24 years against their income. But it was primarily set up for the purchase of investment properties. And for example, as mentioned, it affords the protection of limited liability, but if negatively geared, a shareholder can write off losses against personal income. So how this basically works is negative gearing is a practice where an investor borrows money. You buy a property, which is an investment property, and expects the gross income generated by that investment, at least in the short term, to be less than the cost of owning the property. What happens is, so they're making a loss, they can write it off against their income, but then when they sell it and make a capital gain, they pay no tax on that. So it was primarily set up for this. Now, Mr. Speaker, you may ask, why am I talking about this? The reason I am is because a very decent chunk of this bill is reviewing and changing the look-through company tax regime. So what happened in Budget 2010, it's a fair question. It proposed to change the qualifying company regime with a look-through company. Very similar, whereas qualifying companies were taxed like a partnership with corporate form, shareholders were taxed at personal rate, not at 28% of the company rate. Capital gains are tax-free and shareholders can access losses. But there was opposition to those who wanted even a better deal. These were the guys who could afford the tax lawyers, who understood aggressive tax planning, and what they wanted is a company tax rate and access to tax-free capital gains. And the result of this was the look-through company regime, but they kept the existing qualifying companies, i.e. you couldn't start a new qualifying company, but if a qualifying company existed, you didn't have to fold it and replace it with a look-through company. But what they did promise in 2010, December 2010, was a review of this system. And what this bill is the result of that review. Now, what is a look-through company? A look-through company is a company that elects, so it has to be elected by the shareholders to be treated as transparent for income tax purposes. It's like a partnership. It does not pay income tax in its own right. Rather, its income and expenses flow through to shareholders and are taxed at its marginal tax rates, and losses can be offset against other income. There are many advantages of a look-through company, and what I'm very interested in and what we'll be looking at very, very closely with a review of this legislation and a review of the look-through company regime is to make sure that investors are actually paying their fair share. And what this bill doesn't do is legislate for tax-free capital gains, which in effect what it is. There's something called a tainted capital gain, and I won't go into the detail of that because I've probably only got about 30 seconds left. But what we're saying is we're going to take out the tainted capital gain, and it will only apply to asset sales between companies that have at least 85% common ownership. I guess what I'm saying, Mr. Speaker, is this bill does deliver on the promised review of the look-through company regime, but what it doesn't deal with is the capital gains tax issue. So what is happening, Mr. Speaker, is investors can still get tax-free capital gains on assets if they invest it and buy them and sell them through the look-through company without having to liquidate that company. And I don't think that is particularly equitable when the vast majority of good, hard-working or middle New Zealand are actually paying tax on every single cent they earn. You invest in a look-through company, you earn capital gains tax, and no tax is paid on that. So this is why I'm looking forward to this. I'm looking forward to what the submitters say, and I'm certainly looking forward to what the IRD says on this rather important issue. Thank you very much.
Mr. Speaker.